All right, welcome everyone to the Sunday macro wrap up for Sunday, March 16th. Where are we at right now in the cycle? Are we going to have a bounce this week? There's lots of indicators that are suggesting that, which we'll go over here in a second. But also as well, I think that we just have to keep in mind that these big market moves, it's not necessarily what we need to happen or want to happen. The market's going to do what it ends up doing. And so, what I always try and talk about is, and what's helped me a lot is, if you're trying to position yourself as like a professional athlete when it comes to markets, that's the way to view things. Because, you can prepare all you want, but, if you're in a game, you're never going to know when the opponent is going to make a move, right? All you can do is be trained as well as have your game plan for when opportunities strike, as well as defend yourself as best as possible. And so, part of this macro optics channel also is to help develop that mindset of, not looking at the markets as if it's just a glorified, online casino. We have to look at this as a tool in order for us to preserve our purchasing power. Because I was talking to my sister today, and we were just, talking about the housing market a little bit down here in South Florida, and kind of the whole entire the K-shaped economy with the way that things are post-pandemic, where asset prices have gone crazy, but wages have not kept up. And that's the real big issue here. And so the banks, as long as we're in this type of fractional reserve banking system, well, now it's zero reserve banking system, but our purchasing power is going to continue to dwindle. And it's our responsibility for ourselves and to our family that we do our best in order to keep preserving our purchasing power. And so that's what this channel here is all about, and what we're going to continue to do. And so with that, let's go ahead and get into some of the charts here. One second, let me go ahead and share my screen. All right, so for those who are new here, thank you for joining. The way that these Sunday macro wrap-ups work is that they're an hour long. The first 30 minutes is live streamed for whoever wants to see the stream, and then the last 30 minutes to 45 minutes are just for our members. And so that's what we'll go ahead and cover any actionable ideas that we're looking at, specific tickers, as well as what I'm personally looking at throughout the week. And so, if you guys want to learn more about our macro optics community, just go to the link in my bio, or what you can do is you can go to school.com/macro optics, and you can start a 7-day free trial there. But let's go ahead and get through some of the data that we saw last week, which was on Tuesday. We got the Small Business Optimism Index. And this is one of the key indices to look at, because obviously, small businesses make up a large majority of the consumption component, as well as productivity component of the United States GDP. And what's interesting is that, this is going all the way back to 1986. When we take a look at what happened post Trump election back in 2016, we can see it had a similar jump before it came down for a couple months. I'm sure you guys have seen that chart where it shows, Trump's first term versus the second term, the S&P 500, and obviously it's down a lot now. But the past couple months of the optimism index since the Trump election has dramatically come down. And if we look at videos from macro optics that we did a couple months ago, we were saying that, hey, just like what happened in the first term, you might have a little bit of a pullback, just because the market was pricing in near perfection that, this new administration was basically going to bring heaven on earth, so to speak, in terms of like the financial markets. And so what does that mean? It means that it wasn't pricing in any risk at all. And when that happens, you want to pay attention to those extremes so that you can fade it, or at least manage yourself appropriately with the risk exposure. And so that's what we were doing, and we're getting that confirmation right now from the February optimism index. Now this will play into effect with, a lot of the whatever happens with the actual economic effects from the tariffs. We still don't know, since it takes a little bit of time for these different policies to actually translate into the real economy. So the the amount of uncertainty is still very high. And you can actually see this in the uncertainty index for small businesses, and that's even higher than pandemic uncertainty. So this acceleration is pretty unprecedented. And yeah, it's just global uncertainty is at an all-time high right now. And so the contrast is that, if at any point we start to get data where these tariffs aren't as bad as what's being priced in right now, or even have a net positive, then you could see a very sharp V-shaped reversal from the sell-off that's going on right now. And so that's why we want to pay attention to not only the reaction to that, but also too when we get data such as consumption, imports, exports, those types of things. We really want to pay attention to that data because it's going to determine how the market reacts to this. Now, taking a look at the small business optimism index in terms of each of the individual components, the largest, just like we talked about, the largest thing that was drawing it down was the expectations for the economy to improve. And I know that, some people are saying, wow, it's actually surprising that the previous administration was a lot kinder, a lot more supportive for, the S&P 500 and crypto and things like that. But when you take a look at the amount of government spending, right, for those who are familiar with, my Twitter account, the type of chart that I always like to reference is the one that I have pinned, which is, in my view, and the team's view, one of the most important charts of 2025, which is showing the S&P 500 compared to government spending. And as you can see, government spending bottomed essentially 3 months before the actual S&P 500 bottomed, which is, pretty interesting, right? And so, when taking a look at that, it's no surprise that a slowdown, or at least not as much of a, spending stimulus, is going to have the opposite effect of what it's been doing over the past, 2.5 years. And this is something that we've also been talking about. Not to say that it's a bad thing. I mean, the markets can't just go up in a straight line forever. You're going to have corrections, but it's going to present an opportunity for the people like us who are paying attention to the macro versus someone who is just reacting and going from headline to headline. So that's what we saw there. We also got jobs data, specifically JOLTS, so job openings, as well as hires and total separations. Those actually continue to remain negative on a year-over-year basis. And so what that means is that it's just a further confirmation of the hiring freeze that's going on right now, whereas, companies and corporations aren't firing, but, they've taken off a lot of their openings, as well as they're not hiring as much as they were a couple of years ago. And part of that too is that with the government spending coming down, as well as this deglobalization coming into effect, a lot of the corporations over the past 15 years have benefited from, outsourcing labor to other countries like China, where, there's no way that in this country, corporations would get away with hiring or paying those types of labor wages. It's essentially slave labor wages that we are taking advantage of. And so the pain of going from a globalized economy to a deglobalized economy is going to either have two things. One, things like our iPhone or other things are going to get way more expensive, or these companies, these corporations are going to have to eat into the insane margins that they've been enjoying over the past 15 years. What does that end up doing? I mean, it's a double negative, right? It's either prices continue to skyrocket and price gouging continues, or a lot of the you're going to see margin compression, which both scenarios end up being a headwind on the stock market. And so it's just a combination of all these things coming together. We also got inflation for February, and just like we were talking about when we were looking at the price of oil and other things that we look at, commodity prices, those also came down in the month of January. And so the February print, it was no surprise that that came down a little bit there, but it still remains elevated. As we can see here, headline inflation is at 2.8%, while core inflation is at 3.14. That's still much higher than the 2% goal. And so as this is a good trend, which, just looking at the data, I think that this disinflation could continue. But if growth is slowing at the same time, that is not an area where, things like crypto and stocks end up thriving as well. And also, too, this is getting the 10-year U.S. government bond yield down, which is what this administration wants to do, wants to bring down borrowing rates. And then similar to input prices, producer price index, that also started to come down. But as you can see, producer prices have been accelerating, ever since June of 2023. And, we've had a couple months periods where this has cooled down a little bit, but then it went on to reaccelerate. So again, just because you've had 1 month of disinflation does not mean that it's going to continue. We really need to see 2 more prints of this coming down. But I think we might see that. And then lastly, on Friday, we got the University of Michigan's Consumer Confidence Index, and that's posted its worst month since December of 2023. And as you can see, it's had 3 large months of deceleration from where it was back just in November of 2024. And it's just another uncertainty measure, right? And again, this could fully reverse if we end up getting more data that things aren't as bad as expected. And so we would just remain in that cautionary area. So that was last week. This week, we still have a decent amount of macro data that's coming on. Tomorrow, we have core retail sales, which is a consumption measure. So we look at that as an input for our GDP nowcast. Same thing with the Empire State Manufacturing Index. So that's New York manufacturing. And we also get some housing data information as well. And then on Wednesday, that's the second Fed meeting of the year. So on March 19th at 2:30 p.m., Jerome Powell is going to get on the television and go through his canned responses that makes him sound like a robot, as well as he always says the same thing. And you have to pay attention to the dryness for about 2 hours to catch one word that he says differently, and then everyone has a market reaction because of that. Some of the things that I'm going to be looking for, which will also be live streaming that day, the entire press conference, and so I'll go live at 2 p.m. on Wednesday instead of our normal 3:30 p.m. Because the press release actually comes out at 2, and then the conference starts at 2:30 and goes till about 3:30. And so we'll be live streaming it there, and also I'll give some commentary because they use a lot of bank terminology, and I'll give some more color, and we'll have some laughs, as we live stream that. But a couple of things that I'm looking for is more guidance on quantitative tightening. So as we know, the Fed has been reducing assets on their balance sheet, but part of the reason why they were able to do that is because also as well, they were draining the $2 trillion in the reverse repo facility. And so let me see if I can bring up a chart of this here, but 1 second. I'm switching both screens on YouTube as well as for the Zoom call people, for the members. But going over to the, so this is Fed liquidity. Here's the assets. So this is QT that's going on, right? They're reducing assets on their balance sheet. And the reason why they were able to do this without any type of real headwind was because of the drain in the reverse repo facility, which as of right now, it's had a little bit of or it's hovering around 100 billion. And so I have this yellow marker there because it's having a little bit of struggle staying below 100 billion, but you don't have this cushion anymore. And so with that cushion gone, really the only thing you have is the Treasury General account, which, that's really started to drop. This is the checking account that's held at the Fed. And as we can see, that's being drained right now because of also everything that was going on with the continued resolution for the 2025 fiscal year, which ended up getting passed, but it's still being drained here to supply ample liquidity because the reverse repo is drained. And so all this to say, what I'm looking for in the Fed meeting this week is, are they going to give more forward guidance on quantitative tightening? Because, they're running out of juice essentially. And I think that um, what Jerome Powell has said in the past is that he's going to reduce rates before he does quantitative easing. But as we saw back during March of 2023, as QT was still going on, as the tightening was going on, there was this large acceleration in assets, which was from the temporary bank term funding program, which if you guys remember that, it was a random facility that was created by the Fed in order to provide bank reserves to those regional banks that were essentially getting bank run during that, or bank ran during that time. And so this little blip right here essentially showed the entire world that they can continue QT and just create any type of temporary lending service to just provide relief, even though it does, increase assets on their balance sheet. They can still do the bottom line QT if they have to do some of these one-off shoots. And so just because they did this one time, I wouldn't be surprised if they keep doing it more, of some more, banking scares come into play. And so I think that at some point they'll end up stopping QT this year. Obviously, if it gets bad enough, they might even go back the other way and drop rates and actually do QE. But they do have other shadow QE measures that they can do with that evidence right there from the bank term funding program that they used. And so that's what we're pretty much getting this week. Let me go back over to the slides here. Now, taking a look at the Cleveland Fed's inflation nowcast, they have CPI coming in at 2.49 for the month of March. That gets reported next month, in the month of April. And then they have core CPI coming down to 2.99, but essentially 3. So not changing very much. And so Cleveland Fed is being much more cautious with their inflation nowcast and saying that it's going to be a little bit more sticky than most people think. Looking at the CRB commodity index, again, this started to come down a decent amount here. It's really started to slow down from its acceleration back in the middle of January, which is what I think this most recent print was pricing in. And then it really had another acceleration from the beginning of February until mid-February. And then it's having a little bit of a drop off now. But this is one of the things that we watch for inflation. And so with this coming down, that could be more tailwinds for disinflation. And then switching on over to growth, checking out the Atlanta Fed's GDP nowcast. This gets updated tomorrow, but as of the most recent print, that was at negative 2.4% for the Q1 GDP nowcast there. But a lot of it is skewed because of the massive amounts of imports that were front ran from businesses that were trying to get ahead of the potential effects of these Trump tariffs. And so that could have an unwind. We'll see what happens. But a lot of this number was skewed based off of that, preemptive action there from businesses. What is interesting is that financial conditions started to tighten a little bit. So this is the St. Louis Fed Financial Stress Index. We mentioned a few weeks ago at the end of January how, this was at all-time lows. And that was really a time to be a little bit contrarian because it only got that loose another time back in May of 2024, and then again in October of 2021. Those were the only two other times that banking conditions were this loose. And that typically, historically, has been great times to take profits. Obviously, getting out of the market in October of 2021 would have been great. But, we were paying attention to that. Now it's had a large acceleration here where, this widening or this increase in financial stress, we could be looking at, a little bit of a reversal here, just like we saw back, around August of last year during the Japanese yen carry carry trade unwind scare. But taking a look at the Chicago Fed's National Financial Conditions Index, we can see that that also had an acceleration. We'll look at credit spreads here in a moment. Banking credit, so this is private credit, that has had a slowdown ever since the beginning of November as well, and it hasn't had a reacceleration. So bank credit has also slowed. These are all things that we have noticed that is contributing to something that we haven't seen over the past 3 years. Same thing with bank reserves. So part of the reason why when people and these bankers go on TV and say that, there's money printing going on, it's really just the creation of bank reserves that allow banks to be more comfortable with, doing loans to businesses and individuals. But one thing that I point out in this tweet here, or X post, is that bank reserves on a year-over-year rate of change basis just went negative again. So as you can see, I have it circled in red here. The last time this happened was in February of 2022, as well as February of 2018, right before you had a lot of different headwinds in the markets there. So, even if we do have a bounce this week, as long as, bank reserves remain negative year over year, as well as we don't see, if we continue to see a tightening in financial conditions, again, that's just going to be more headwinds going forward. And so that's the type of stuff that we want to pay attention here. And if we do get a large bounce next week, which again, totally can happen, you have to be aware that some of the largest 1 week or 1 day moves in the S&P 500 happen during bear markets. And so we just have to keep that in mind there. Taking a look at the 4-week moving average of initial jobless claims, switching over to the labor market conditions, we can see that the labor market continues to not be as much of a worry as the tariff wars, as well as growth and inflation slowing down at the same time. But as you can see, over the past couple weeks in February, as well as into March, we've had an acceleration in initial claims, but still below that August 3rd, 2024 high. And so, the jobs market is still softening, but it's not as much in the forefront as it is with inflation, growth, as well as the tariff wars. All that to say is that the target rate probabilities for the Fed meeting on Wednesday is that it's a 99% chance that they're going to keep pausing and not cut at all. And so, this target rate probabilities chart from the CME group has a pretty great historical accuracy. Of course, it's just a percentage, anything can happen. But typically, this has had the correct call, especially as you get closer to the meeting. And so, it's what the market is pricing in right now. And so even if they pause, I don't think the market will have a crazy reaction because it's already priced in. I really think what it comes down to, as well as all these different press conferences, is what Powell says in the press conference and his reaction to different questions by the press. And so to me, like if I was the Fed chair, I would be like, let's stop these. We're already telling the market what we're going to do. Why are we still going on TV and like spooking the markets when we are caught with our pants down from a reporter that sneaks in a question that wasn't pre-approved or something like that, right? To me, like if I was the Fed, I would just be like, all right, let's stop doing these press conferences. But they continue on, and I guess that's what's going to cause volatility in the markets in the future. But same thing with the May meeting. After this March meeting, on May 7th is the next Fed meeting, the third one of the year. That's still an 84% chance that they're going to continue this pausing regime. And then the first cut is being priced in the June meeting. So that's a 25 basis point cut from where we're at right now. Still a 17% chance that they're going to pause. But the bond market is sniffing some trouble here in the next 3 months, which is also in line with our other indicators that we take a look at, where we were expecting, or that we are expecting right now, a little bit more volatility increasing towards the summer months. Taking a look at the earnings calendar this week, nothing too prominent. The biggest company that's reporting is Accenture. The ticker is ACN. We can take a look at that chart here momentarily. But one other reason that I'm looking at in terms of how there might be a bounce this week is that when taking a look at leveraged holders in S&P 500 futures, right? So this is like hedge funds. This is the commitment of traders report, and essentially the net positioning was a lot of short covering. And as you can see on this chart here, the only other time that we had this much short covering has been all the way back when we've had recent bottoms in the S&P 500. And so this was back in November 5th, August 6th, April 23rd, and October 24th of 2023, all of which came to this negative 200,000 contract net positioning mark. And that historically, in recent history, has been, where you've seen different reversals. Now, again, it doesn't mean that this is going to reverse and we're going to be going back to a bull market. That's not what I'm saying. We can only confirm that in hindsight, but this is a historical bullish divergence that that I've witnessed in the past. And so, again, I would not be surprised if we have a pretty aggressive pop in the markets this week. And so, we've seen that a little bit already when we take a look at the S&P 500 here. Let me just switch over the camera here 1 second. And so into Friday here, we can see that, we did have a decent pop here. It was on okay volume, but, what you're seeing here is the sideways action has been on lower volume, which is a bullish divergence. And so, yeah, I mean, I wouldn't be surprised if we had a decent pop here heading into the week, especially with the volatility index of the S&P 500. So the VIX, this was a key metric to watch, and it still is, but that has come all the way from near 30, which is high, all the way down to 21. So this is a huge swing down in the volatility index. And so if it remains above 20, you still want to be cautious. Like, that doesn't mean that you just go out and, empty out your savings account into this dip. It essentially means that we need to pay attention to see what the VIX does from here on this next bounce. Because if volatility continues to decelerate, and maybe if we have a bounce that has a large volume acceleration, that would be a pretty decent bullish divergence. And, I showcased this last week, and this is, typically what we look for. But let's say, and this isn't, I'm not making a prediction. This is just a demonstration for things that I like to look for. Let me make a better line than that. So what I would want to see for an actual, a reversal here, let's put a marker right here at 57.85. Let's use the SPY just because everyone's used to seeing that in their account. So taking a look at the S&P 500 here, let's place a mark right here, right before this gap, previous support resistance. Now let's say that the S&P 500 does something like this on higher volume. That would be a bullish divergence, right? But then, it starts to get some resistance around this level and it starts to come down. But then, this previous past support and resistance line becomes support now, and that is on lower volume. So when you see that decline on lower volume, that's also a bullish divergence. So you get double bullish divergences. And then if this comes back up and then breaks through this previous resistance level, that would be something that would really perk my ears up in terms of the market going back and having a high probability of going back to a bullish trend. Now, obviously, this might take a couple weeks to even confirm, but the whole purpose of having a macro process and a model is that we can be patient and let the market confirm what it's going to do and have it speak to us before we just try and call bottoms and just buy stuff just because it's down. We don't buy things in bearish trend, and we are patient enough to wait until something confirms its bullish trend before we start to buy dips when it's back in a bullish trend. Because again, zooming out, we want to pay attention to the longer term upswings, right? So just like back in August of 2023, why try and pick bottoms along these along these price drops here, like trying to pick that one. Nope, kept going forward or kept going downward more. Nope, kept going downward more. Instead of stressing out trying to catch a falling knife, let it confirm its bullish trend here, and then that way, once you're able to get that confirmation, you can then take advantage of this move here, right here, right? This 32% move. And so that's what I'm looking at here, is that, I want this price movement to confirm its bullish trend, because what I have in my mind would be, catching this next move if it ends up doing that, right? So again, always have patience. Don't worry. It's going to be all right. Let the chart confirm for us. We don't have to do any type of special guesswork or anything like that. And so, yeah, that's what I'm going to be paying attention to heading into this week in terms of, if we end up having a bounce here. So volatility index, as well as what if we have a bounce, paying attention to different support and resistance levels, as well as volume at the same time. What I wanted to also showcase, which was what we were talking about beforehand, which was a widening in credit spreads, or a tightening in financial conditions, is looking at credit spreads right here. And it's getting close to our 3.5 level, which is what we typically look for. But yeah, I mean, this has completely reversed now. Credit spreads are bullish. And so this is, considered a tightening of financial markets. And that's obviously been a lot different from what we've seen over the past few months here since August. And we really haven't seen a spike in volatility, or we haven't seen a widening in credit spreads from when, back in August during the Japanese yen carry trade scare. So that was the last time we really saw this. Now, again, we'll have to pay attention to see what happens from here. If it ends up coming down, just end up being patient. It's okay to let the market confirm things before we just try and act like a hero and buy dips with the risk of it catching a falling knife. The dollar remains in bearish trend. We have the Bank of Japan announcing its monetary policy this week. So, taking a look at the Japanese yen versus the US dollar, that remains in a bullish trend, as well as some of the other, foreign currencies. If we take a look at, the euro, pounds, all of them are in bullish trend compared to the dollar. When we take a look at mega caps, all of them are in bearish trend in our model currently. And so, we're going to be waiting and seeing what they do from here. But yeah, can't remember the last time that all the mega cap or all the meg sevens were bearish at the same time. So that definitely is notable. One thing that the macro optics team has been continuing to be long is gold, and that hit new all-time highs last week, and it's continuing to accelerate there. So we remain long gold, and this has been one of the top performers so far in 2025. And I think last week, let me see here, the best performing ETF was actually silver miners. So yeah, people chasing, some silver miners. SIL was the ticker for that. Obviously, you would want to, if you wanted exposure, you'd want to wait for a pullback. You don't want to chase as it's already had a decent acceleration here. So we will be patient for those on red. And then let's see here. International equities had a little bit of a correction last week. One of the ones that the team and I likes to look at, and we were buying some more, was Poland. And so it did have a little bit of a pullback last Monday on March 10th, but that was really the only time other than March 3rd. And so, yeah, the international equities continue to remain in bullish trend, as a lot of international investors are, leaving the Mag 7 that are scaring people, and, they're going into these international equities here. And then China also remains in bullish trend. So Chinese equity markets are, continuing an uptrend as well. And that is pretty much the case here. Bitcoin still remains in bearish trend. Yeah, this chart does not look great. I'll tell you that. But yeah, same with Bitcoin. We remain patient. And when the macro setup as well as the flows start signaling to us that, we could have a bullish divergence in Bitcoin, then, we'll start to pay attention to it more in terms of making a position. But again, we do not buy things that are in bearish trend. So that's one of our rules there. And so it is now 7:30. We're going to go ahead and end the stream and just go directly to our members. But again, for those who are watching the stream here, if you guys would like to join us for the different actionable ideas as well as further discussion here, you guys can go to the link in our bio and start your 7-day free trial in our school community. And once you hop in here, you would just go to the calendar and click on the Sunday Macro Wrap Up, and you guys can join here. But for those who are joining on the call and the members, make sure you stay on. I'm going to go ahead and exit the live stream. So we'll say bye to YouTube as well as Instagram. All right, 1 second.